the next company I want to address is Dixon Technologies. Stock is under pressure, largely, of course, on the back of rich valuations. Numbers were in line with expectations, so they reported a very strong growth, largely led by the mobile segment, which has really pushed the overall numbers to where it is. Mr. Atul Lall is Managing Director at Dixon. He's joining us now to take some questions. Mr. Lall, good morning. Great to have you with us here, sir. Thank you very much for your time. Prashant this side, and it's been a while, so good to see you back on the channel. So just the basic hygiene numbers out of the way to confirm more than anything else. For the full year, at this current run rate, you should be at 40,000 crores in top line and about close to 900 crores in profits?
Somewhere close to that, Prashant. Yeah, you're almost there. There can be small delta here and there, but largely we are going to be close to the number that you're mentioning.
Okay. Got that. Now, before we, and there are always lots of things to talk about with Dixon, because you're backward integrating, you're getting new customers on board, and there are other newer segments, etc., which you're building out as well. But the main bread and butter, the mobile sort of segment, Mr. Lall, if you can tell us, I mean, this particular quarter has seen tremendous growth. I mean, actually, maybe at the expense of some of the other segments which have not grown as much. The share of mobile within the overall pie has actually increased quite a bit. At the margin, as we look at 2025, has there been, are you seeing any slowdown at all from a demand perspective? I was reading this report from Counterpoint Research, which essentially was, I mean, they put out the big numbers. They said that, this is the total mobile manufacturing capacity at the end of 2024. And as of now, only about 50% is utilized. 50% remains unutilized. And they were sort of pointing to sort of slower demand, etc., which they think will pick up in 25. Just wanted your thoughts, sir. So,
Prashant, undoubtedly, mobile is the largest category in our industry, and strategically we started positioning ourselves in a key position there. So that is the biggest growth factor for us. We have grown from 5 million odd smartphones last year to almost 30 million this year. Practically all the brands in the Android ecosystem are our customers. With the latest acquisition that we have, in next 6 to 8 months, we should be almost just 70 million. Please appreciate the Indian market is around 150 million, and Android ecosystem is going to be around 135 to 140 million. So we have a very large play in this. So we have grown from 5 to almost 30 million. We feel that next year we should be at somewhere around 45 million. So that's the way it's going to be. Now, as far as the demand is concerned, we feel, demand has been normal, not exceedingly buoyant, but we feel that in the coming quarters and the next fiscal, demand should. The new technology, new product models are being launched. Also, as far as the margin is concerned, smartphones is a lower margin business globally, and so is the case in India. And that is the reason, in our case, we are going to be deploying a lot of resources and capital in a backward integration play, in the components play, which is more margin accretive. And also, we are expecting the rollout the government PLI for the electronic components in non-semiconductor category. Yeah. So, once those projects are rolled out in the next 2 years, it should be able to restore margins to normal level. So that's the way it looks for the mobile business for us.
Absolutely, Mr. Lall. Hi, morning. Great to have you with us. And I think, right now, the stock's down about 9.5%. I guess the ask is always very high from a company like Dixon, right? Which is, I mean, stock is a great wealth creator. But now, as we say in the market, they'll always mange more. On the point of margins, sir, I think, and that's something that a lot of brokerage notes are also pointing out. Your mobile business is doing fantastically well. Volumes are fantastic. And now it's almost 90% of your revenue. Tell us how the mix will change, because some of the other segments like consumer electronics, that's where you get higher margins. While you backward integrate in mobiles and bring the margin profile up, what about the other segments? And in the near term, Do you see yourself going above 4% on the margin in FY26?
So margin, we feel there is going to be in the range of around 4% in 26. Beyond 26, it should start inching up. Now, as far as other categories are concerned, we are focusing a lot on our appliances category. So we have set up a refrigerator plant. We are already acquired almost 8% share of the Indian market. We are further expanding the capacity, first from 1.2 million to 1.5 million, then from 1.5 million to 2.2 million. That's almost 8 to 9% EBITDA margin business. In other appliances, we are exploring addition to our product portfolio. We are expanding our IT product business, which would also be in a similar range of our 4%, but is going to generate an operating leverage because of the scale. Then we are looking at expanding into the electronic component business. So we've already started work on our display module plant, which is much more margin accretive. So this is what we are pursuing. So as I shared with you, I feel that in 25-26, margin is going to be in the similar range of around 4%. However, once all these action points are fructified, then there would be an up of the margins.
And it will go up to how much?
It should go up another 30-40 bips. It's around 4.5.
4.5 odd. All right. Hi, Mr. Lall. Good morning. I want to focus on your plan to foray into display fabrication business. The total capex I think you're talking about is roughly around $2.5 to $3 billion. So a few points out here. From Dixon, the company, how much will the outgo be? Because there will obviously be some support coming in from the government. So how much are you factoring in out of this $3 billion odd? Point number one, so funding. Point number two is what is the asset turnover? And point number three is the margins as well as ROCE, purely on this business that you're looking at.
So for Dixon to get into the display fab business is extremely important because if we are able to execute this project, it gives us a very, very significant moat. And it's required for Dixon, it's required for industry, it's required for the country. We are still awaiting the guidelines of ISM2 or the Government of India. As per the earlier scheme, the central government was supporting all 50% of the capex on a pari passu basis, and the various state governments are offering almost 20%. So here we are talking about around 30%. This is a high margin business. This is in high double digits, the margins.
Okay.
So on a blended basis, it's going to have a significant impact on our margins. Let's say what the government guidelines are.
Yes.
And then we will be able to determine the ROC. There's not highly working intensive. In Dixon, we have adequate cash flows. We generate significant EBITDAs. We don't have significant working capital.
Mr. Lall, we're just running a little short on time. So just to clear the air, out of this $3 billion, back of the envelope calculations and going by the past precedent, it appears that from Dixon, you'll have to come up with only around 6 to around 700 million. Is that correct?
That also,
very roughly?
If we are able to bring in the equity from a joint venture partner,
then it'll be even less.
That's right.
So it'll be $7 million at peak, point number one. Point number two is you're saying on this particular investment, you'll do margins of double digits and ROCE will be more or less in line with what you're doing. It could be a little bit lower, I'm guessing, because of the kind of capital intensity. Is that correct?
The ROC is going to be slightly lower, but the payback period is going to be very, very fast. On the blended basis, the margins are going to go up significantly. Strategically, it's going to build a huge moat in the company.
And the asset turn will be close to around what? 1:1 or a little lower than that? From this $3 billion of capex, you can generate revenues of roughly around $2 billion. Would that be a fair estimate?
So let's say we are putting around $900 million from the partner side and our side, then it's going to be generating a revenue of almost 1:2, 1.8 to 1.
1 point. Got it. $2 billion approximately. 1.8 to $2 billion. Got that.
Okay. All right. Mr. Lall, thank you very much for joining us. Short on time, but not on questions. So we'll have you back on, sir, for a more detailed chat. But thank you very much for joining us with some of that perspective. We'll